In the world of investing, there are a bunch of myths and misunderstandings that can lead you to make bad choices and miss out on good opportunities. It's really important to separate what's actually true from what's not so you can make smart decisions that match up with your financial goals. In this video, I'm going to break down the top 5 myths about investing. These are things that lots of folks believe, but they're actually totally false. So if you're thinking about getting into investing, it's crucial to get the real facts. Number 1, you need a lot of money to invest. Don't believe the notion that you need a fortune to get started with investing. That's really not accurate. You can totally jump into investing with as little as $100 or less. Loads of investment platforms out there let you start with a small amount, and some even let you buy a tiny slice of a big company. There's a bunch of cool stuff about investing even if you don't have a lot of money. For starters, it helps you kick off your investment journey way sooner. The earlier you start, the more time your money has to grow. Plus, putting in small amounts on the regular can help you dollar cost average, which means you get more shares when prices are low and fewer when they're high. That's a smart way to lower your risk and up your chances of doing well in the long run. And guess what? Investing small amounts can help you build some pretty awesome money habits. When you consistently invest, you're basically putting money away for your future. That's a great way to get in the habit of saving and investing, which is super important for reaching your money goals. So if you're thinking about trying out investing, don't let the idea that you need a ton of cash hold you back. There's a bunch of ways to get going with just a little bit of money, and the earlier you start, the better. Number 2, you're too young to start investing. Thinking you're too young to kick off investing is a mistaken idea that can mess with your financial future. Actually, it's the opposite that's true. Starting your investment journey early is the way to go. It's all about the magic of compound interest. Compound interest is when your invested money starts earning its own money over time. And let me tell you, this can seriously boost your investment gains. Let's break it down with an example. Imagine you put aside $100 every month from the age of 25. If you manage to snag an average annual return of 7%, you'll have more than $100,000 waiting for you when you hit 65 and decide to retire. But hold on, if you wait until you're 35 to start investing, you'll only end up with around $60,000 when you retire. That's a whopping $40,000 difference. Sure, investing comes with some risks, but they're manageable. Just start small and keep your eyes on the long game. If you're on the younger side, you've got loads of time to ride out any bumpy rides the market might take. And even if you hit a rough patch and lose some money in the short term, you've got plenty of years to bounce back. So if the thought of investing has crossed your mind, don't buy into the nonsense that you're too young for it. The sooner you dive in, the better off you'll be. Number 3, past performance guarantees future returns. You've probably heard the saying, what happened in the past will happen again in the future when it comes to investments. It's a common idea that salespeople often use to get people to invest in something. But here's the thing. Just because an investment did well before doesn't mean it'll do well again. Lots of stuff can change how an investment does, like how the economy's doing, how crazy the market is, and what's going on in the world. These things can all change over time, which means we can't be totally sure how an investment will do later on. Believe it or not, there have been times when investments that were doing awesome ended up losing a ton of money later. Take the late 90s, for example, when tech stocks were going through the roof. But by 2000, those stocks crashed big time and lots of folks lost a bunch of money. So the bottom line is this: don't count on the past to predict the future of your investments. When you're investing your hard-earned cash, think about stuff like how much risk you're cool with, how long you want to invest for, and what you're hoping to get out of it. Oh, and it's also a good idea to spread out your investments to lower your risk. Number 4, investing in individual stocks is the best way to make money. Many folks believe that putting money into individual stocks is the ultimate way to make a buck. Financial advisors and the media often push this idea. But the truth is, it's not always the smartest move. Research shows that most people can't consistently beat the market by choosing individual stocks. Why? Well, the stock market is a real maze, hard to predict. Even the pros struggle to figure out which stocks will do better than the rest. Plus, even if you do pick a winning stock, timing when to get in and out isn't easy. This can seriously cut into your profits. And let's talk about risk. Going all in on individual stocks is like putting all your eggs in one basket. If that stock tanks, your whole investment takes a hit. A better plan for the long haul is to mix it up. Invest in index funds or exchange-traded funds, ETFs. These funds follow a specific market index, like the S&P 500. This means your money's spread out over lots of different stocks, reducing the risk and upping your chances of hitting those long-term goals. Sure, there are perks to picking individual stocks. You might score bigger gains if you keep nailing the market. But that's a tough game, and most people are better off diversifying with index funds or ETFs. If you're thinking about diving into individual stocks, do your homework and know the risks. Chat with a money expert to get advice that fits your goals. Number 5, you need to time the market to be successful. One of the most common myths about investing is that you have to play the market's timing game to succeed. This basically means trying to buy when prices are low and selling when they're high to make the most profit. However, nailing the right time to enter or exit the market is incredibly tough and often ends up being more expensive than just holding on to your investments for the long haul. There are a few reasons why trying to time the market is such a challenge. First off, the stock market is always in flux, and there's no way to accurately predict when it'll go up or down. Even if you could predict market movements, you'd have to be lightning fast and precise with your trades. Not an easy feat, especially when things are all over the place. Even if you somehow manage to perfectly time the market, it might not necessarily make you richer. That's because the costs of making trades can nibble away at your profits. A study by the Vanguard Group discovered that folks who attempted to time the market over a decade actually did worse than those who simply held on to their investments. The study showed that the average person trying to time the market lost around 3.3% every year, while those who just stayed invested gained about 7.5% annually. The smartest move for long-term investing is to follow the dollar-cost averaging method. Basically, this means putting a set amount of money into the market regularly, no matter what's happening in the market. This approach helps you sidestep the game of market timing and lets you benefit from market ups and downs over time. So if you're thinking of investing for the long haul, don't stress about trying to time the market. Just stay invested and let compounding do its magic. Exploring the world of investments is all about having the right knowledge, being patient, and understanding what's real versus what's just a myth. By clearing up these common misunderstandings, you can approach investing with a smarter outlook. Just remember, it's important to start with small amounts, kick off your investment journey early, go for different approaches, and not try to time the market. These are all key parts of building a solid financial future. Be realistic, get advice from the pros, and let well-informed choices steer you toward making your long-term money goals a reality. Thanks for watching. I hope you learned something new about investing. If you have any questions, please leave them in the comments below.